How to do futures mean reversion edition coming at you. We're going to have a ton of fun talking about what mean reversion is, talking about what standard deviations are, which markets actually mean revert, how can I use mean reversion to trade futures markets or stock markets or options, all this fun stuff. Another tool in your tool belt. Hopefully you're going to learn a lot today and get a little peek at what was my first strategy here in mean reversion. I think in a lot of places, the first strategy for the new futures trader, because it's one that doesn't depend on opinions or doing a bunch of research about oil or agricultures or anything else. So we are going to get into this statistically based strategy here today. So stick around. It's going to be a fun one. Before we get into the thick of mean reversion, you must look at this disclosure, or actually you don't. I just have to put it in front of you. You can close your eyes and I'll tell you when the presentation actually starts. Okay, we're back and we're getting into mean reversion, which is defined simply as the idea that a price or measure will revert to its long-term mean at some point, if not already there. And so what you have here, and those of you who maybe know what a mean reverting market is or what mean reversion is in general, can already see that this is just a prime example here in the S10Y market. This is the 10-year yield, one of our really nice new products here. It's the interest rate from the US Treasury. And what you see here is a really nice oscillation around the midpoint in the graph. Now, what do I mean by that? We started out at the start of 2018 rallying up to $30, came all the way down to a low of $5, and now we're meeting in the middle to split those. And that is a lot different than a stock chart. You look at Tesla, or you even look at the indices like the S&P 500 or NASDAQ, and you don't get this long-term back and forth around a central midpoint. That is the general idea here of mean reversion, and we're going to get into what it actually looks like and everything else. But I wanted to start out with just the simple definition and also a simple formula for it, because I think a lot of people get bogged down in the idea that statistics or mathematical theory or probabilities it's too big, it's too lofty, I can't really grasp it. But a mean is really just a summary of data, and here the data is just price history. Where did this market close at the end of the day for the last month, for the last several months, for the last several years? And you simply sum up all that data and divide it by the data points. It's an average, for lack of a better word. This is simply an average. And those of you who are technical analysts and everything else, this is just the moving average at the end of the day over any course of time. And we'll get into it at the end of the presentation. But, we're looking at daily closes. You can calculate a mean based off of minute closes, second closes, 5-minute closes. Like, you can really get whatever mean that you're looking for, whatever time frame, whatever look back period. It's really not that crazy of a statistic at the end of the day. And it's a really good, I use that word summary, it's a really good summary of a market that is easy to calculate here. And so that's what we're looking at when we're talking about a mean. Now let's see in practice what this mean looks like. For example, the mean for the last, call it 3 years, 3 and change, worth of data in S10Y, the 10-year Treasury yield index, it's around $20 or 2% in terms of that yield. This is exactly what we're talking about. You look at the last few years here, you see prices as high as $30, as low as $5, but that oscillation, that word that I used earlier, around a certain value, a certain midpoint, that mean is the summary that shows you just exactly what that midpoint is. And from there, you can see with this long-term chart that we've actually seen a good deal of mean reversion from both sides here, as prices got, like I said, as high as $30 or 3% in that 10-year yield, reverted down to that long-term average, went through it pretty cleanly, got all the way down to 0.5 percentage point in the 10-year yield. Everybody's calling for negative rates. Oh my gosh, they might break below 0% and everything, but the mean reversion traders out there were probably buying up this yield. I know I was down there, banking on the fact that we're probably going to revert back to what is historically normal. Now, of course, there are instances, we saw it last year with crude oil, where, and that's another great market for mean reversion. We're not getting into it today, but as a quick aside, yes, of course, every once in a while you do have the market that goes away from that mean. Crude oil got near zero, and then it went through zero. So, of course, this isn't a guarantee at the end of the day, but now you see crude oil trading at about $60 a barrel. That's right around the mean for crude oil historically. So yes, there are big derivations away from the mean, but at the end of the day, if you are trading on mean reversion, you're basically saying to yourself, hey, that thing's going to go back to what's historically normal. And that's something that I, as my own personal trader, that's what I like to do, as opposed to betting on this thing is going to go through 0% yield and it's going to, all hell is going to break loose. We often see normalization more often than not. Now, with that being said, it's not as easy as you might think. For those of you who trade a lot of options or look at the VIX index, for instance, I remember the first time I looked at it and read the white paper from CBOE, great information on that index there, and it's a really intriguing product. I remember the first time I read it, I was like, oh, so like if it goes below 10 or 11 or 12, I'm just going to buy the hell out of it. And if it goes up to 60 or 70 or 80, I'm going to sell as much as I can, and then I'll just be right at some point. It's rarely that easy because you do have these fluctuations, like here in the yield, for instance, at one point it came down from $30, came down to 15, and then bounced back really quickly. And then if you said, oh, okay, well, the next time there in the early part of 2020, it gets down to 15, I'm just going to buy it again. Well, then it extended all the way down to $5. So mean reversion can occur in any time frame. And that's what makes options and trading the VIX, for instance, a very difficult yet fun and intriguing process, which is like if VIX gets down to 10 and I'm buying options because it's historically cheap, it's below that mean, well, that reversion could occur in the next day. It could occur in the next month. It could take several months, and at which point I'm buying options, waiting for this reversion. And that time elapsing could really hurt you when you talk about theta. Thankfully, we're sticking in futures here. You don't have to worry about theta or anything like that. But just a note here that mean reversion, a really cool concept, one that I love to trade off of, but it can absolutely occur in any time frame, and it can occur from any point. If we say 2% is the long-term mean here for the 10-year yield, well, it reverted from that upside by getting just $10 above that mean, or 1 percentage point above that mean. It got as low as 1.5% or $15 below that mean there. So once again, interesting theory, great tool, but you can't necessarily hang your hat on, oh, it's guaranteed to come back in this time frame from this level here. There is still an art to trading, even though you use this technical, this analytical science to help you in that art there. Theoretically, this market could, and we structured the S10Y product in this manner, it could have gone to zero, it could have gone below zero, and then mean reverted back all the way up. So there is still, a good deal of patience required and strategy required to trading. Not as simple as just buying below that mean and selling above it. And so now I'm not just going to leave a cliffhanger here and say, go figure it out for yourself. How do you know when to buy or sell based off this mean reversion? And here I've given you some very cute little colorful arrows to show some examples of like, okay, well, it was above the mean at $25 if I look to sell at the midpoint of 2018, but then it went all the way up to 30 and I would have been out $500 per unit. That's no fun. Maybe my mechanics tell me that I want to take a loss at $100 or $200. I would have been out that trade before it even came back for that mean reversion. And I would have been right by the early part of 2019 there, but I got in too early. Same from buying. when should I start looking at opportunity here? Because it's not a matter of saying the mean is 20, so I'm going to buy 19s, 18s, and everything else all the way down there. You can get tapped out of these positions pretty quickly. And like I said, there's no guarantee around where you're going to see the mean reversion, when you're going to see the mean reversion. But what can help is the mean's very good friend, standard deviation. Standard deviation is a measure that lets you know where potential value really sets in, and also helps with realistic opportunities, which I want to get to in closing, which is, after knowing where to enter, where should I get out of these positions as well? And so the standard deviation, before getting too deep here, is a calculation that's a little bit more involved here. You've got a square root, you've got a sum there, and a lot of different variables. Ooh, some Greek letters even thrown in there. Anyways, it's something that you necessarily don't want to be calculating yourself, although if you do have an Excel spreadsheet open with data in there, they do have a standard deviation function that makes it very easy. But that being said, all the small subscribers get these standard deviations in their inboxes every Monday morning. Also a nice little plug there for the subscription. If you haven't already checked it out, subscribers.smallexchange.com. They get the standard deviations and the forecasts for the week and everything else every Monday, updated for all the small products. But yeah, this is a measure that pretty much tells you, okay, I gave you the mean of the data at $20 in S10Y. Now, how much does all of the data tend to deviate from that mean value? Because, this is just a month worth of data, but in our example here that we'll get back to, multiple years of data here, hundreds of data points, spitting out one mean probably isn't going to be enough, right? Like, it's like looking at correlation and being like, oh, it's one clean number that lets me know that these things either act similarly or they don't, but I can't really hang my hat on this and say, oh, this is the one thing that's going to guarantee me success here. Same with the mean. It's really, really important and really great to look at for those neutral traders, those non-fundamental traders, people who like to use math and numbers more than opinions necessarily, but you almost need this standard deviation to let you know what is good value. Because otherwise, you look at that $20 mean and you might just say to yourself, well, buying 19s and selling 21s, that's good value. But no, the standard deviation at $7 or 0.7% in terms of the yield lets you know that getting out to that level of $27 or down to $13, that's when you're starting to see an extreme where the data really doesn't tend to deviate that far on average. And this is just a great pairing. I mean, if anybody's ever taken any probability theory courses or statistical theory courses, the normal distribution, you're always given a mean, and you're also given that standard deviation to let you know what that data is portraying or what a random variable could possibly do. And so it's always a great pairing to have the mean, $20 in this scenario, plus or minus $7. And outside of that $7, of course it can be breached. Like we talked about already, could get down to $0. This yield could skyrocket here in 2021 all the way to 4%, 5%. It's happened in the past. Of course, it can get up there, but the standard deviation is a good measure of, like, when it does breach outside of there, it doesn't tend to live there very long, though it can breach it, like we see here in the last couple of years. Of course, if the standard deviation wasn't breached, you would have just all of the data there, right? Like, there's no summary, there's no need for the standard deviation if there aren't some data points outside of it. Now, that being said, more often than not, and we'll get to probabilities and percentages here, hard numbers in a second around the standard deviation, more often than not, the data does live inside this value, and it can, and this is where mean reversion traders really hang their hats, is bouncing off of these standard deviations or getting a little bit beyond there and then coming back. And you can see here that many times it does hold, and when it gets outside of there, that's when you start seeing the news stories roll in and the call for the 0% and everything else. But like we already talked about, more often than not, it does come back. And now I want to hit some of these probabilities here. The standard deviation, one standard deviation, is equivalent to 68%. It's a big number. It's a number that you've probably, if you've traded options or you've looked at math theory or standard deviations, you've probably come across this number of 68% before. Now, it's merely telling you that, okay, I've got a ton of data in this data set. I've got my mean, which tells me the average. It gives me like a full-formed single number summary of all of the data here, this full chart that we're looking at. The standard deviation lets me know where 68% of the data exists around that mean. And so with that being said, 32% of the data is going to reside outside of the standard deviation. Now, the quick thinking, the first gut reaction is usually like, well, why don't you give me a number that has 100% of the data inside that boundary? Well, you don't have opportunity then, right? Like if you're looking at a 100% confidence level, going back to the slide, 100% of the data being in whatever bound, well, that just tells you that the market never gets to that bound, and so you never get a chance to buy or sell at those levels, right? So the standard deviation, 68%, is a good middle ground that lets you know where most of the data, most of the trading resides, while also getting some of those outliers mixed in where I think most of the opportunity comes in. And the 68-32, that's a relationship that now that you know it, you'll probably hold on to forever. It's numbers that you'll probably start to see in your trading research more often, like, oh yeah, that's why that 68 number exists. Or with I know a lot of people like to look at those strangles and the 16 deltas and everything else. And it's like, well, why does that exist? Oh, well, 16 delta on both sides, that's 32%. That's one standard deviation. I'm selling the options right at where this market tends to stay inside of. But going back to that same analogy, if I sold the 0 delta options and got 100% of where the data has been in historically, guess what? No credit in there, no opportunity. So just another example of how the standard deviation works in your trading. Now, where does it not work? Obviously, the equity market. You look at a stock market like the small stocks, the SM75, a nice product here from the small exchange. It's got financial stocks, industrials, materials, energy, and technology in one small, standard, and simple product. Not a lot of mean reversion here. Like, this is very different than the chart that we saw with yields, where it's like, oh, it's higher than the mean, it's lower than the mean, but it usually tends to, in the long term, revert back to that mean. We have an equity market that over the last couple of years, over the last decade, over the last couple decades, trends higher. And so there are markets where you want to stay away from mean reversion trading, because you jump in here and you say, oh, the mean is $50 in the SM75. Well, I sold 55s, I sold 60s, I sold 65s, I sold 70s, and now we're sitting all the way up at 73. Now, of course, a lot of people think that this stock market is overvalued and that it should come back, and it very well may, but when you have a market that is based off of, rising prices for specific companies and all of that factoring in, you can't really hold on to mean reversion at the end of the day with that. But with interest rates and some of these commodity markets like crude oil, like I mentioned, gold, another one that is well above its long-term mean, but usually over time tends to come back. It's a funny thing. You can almost think of it like, if I checked my platform 5 years ago, 10 years ago, and 15 years ago, and then today, do the prices in each of those spots look totally different? And with interest rates, you'd say, oh, well, 5 years ago, it was around, 1%. 10 years ago, it was around maybe, 2 or 3%. 15 years ago, it was around 3 or 4%. Now it's at 2%. No, those are all in the same ballpark. But if you look at NASDAQ, for instance, and you say, oh, well, today it's, above 10,000. 5 years ago, it was in the 5,000, 6,000 range. Before that, when you go 15, 20 years ago, it's in the hundreds. totally different ballparks in all of those, so you can't really hold on to mean reversion in some of these asset classes. Now, that being said, mean reversion can occur for almost any market in the short term, and this is where this really gets interesting for the active trader, and this is where I lend a lot of mean reversion tactics here in trading futures. Like, the long-term trends are great and they're super helpful, and they're great for price extreme trades. That's a term that some of you might be used to, which is to say, like, when S10Y was down at $5 and 10-year rates were at all-time, that was literally all-time low of 0.5%. That is a long-term price extreme that I loved getting on the long side of. But with that being said, those opportunities only come by every once in a while, hence the name price extreme or outlier, whatever you want to say. But you can lend mean reversion to short-term opportunities that you could see potentially every day. How do I do this? I call 0 unchanged, no change on the day, the mean, and basically bring to my trading this idea that's very common in the theoretical study, probabilistic study of markets, which is, at the end of the day, I think that this market will be pretty close to where it started. That's like Brownian motion and stuff like that. I don't want to go too far here and scare anybody, but it's a popular idea whereby where the market opened today is where it's likely to close. So with that being said, you have here on March 17th a great example of trading rates. That was the day that the Fed governor came out and talked, and they chose not to change rates, but they had some words in a press conference. And you can see that the standard deviation in the S10Y product being around 20 or 30 cents, you saw both sides of that market. And yes, it settled down on the day, but you have throughout the day multiple opportunities for mean reversion. Got all the way, it went from 1660 up north of 1680, came back to that mean, went all the way down to 16 and a quarter, bounced back for a little bit, and then closed lower on the day. Mean reversion in the short term gives a lot of opportunity to contrarians who want to get on the other side of these large moves. This is more my wheelhouse, whereby if you tell me that the standard deviation around that net change of 0, that mean, there is 20 or 30 cents, then I'm selling up 20 or 30 cents and I'm buying down 20 or 30 cents, and I'm just looking for some short-term opportunities in there. And of course, 30% of the time it's not going to work out, but you bank on the fact that if I do this often enough, if I'm not only doing this in yield products, but metals and energies and everything else, the 68% of the time comes through there with the large number of trades. That being said, there are plenty of trend followers out there who use this tool to find potential breakouts, or they ride the wave, so to speak, which is, a totally viable strategy as well. You look for, oh, this market is up, close to 1 standard deviation. I think that it's going to build in some ground and get a little bit higher before it comes back. Same with the downside there. I'm going to sell into this weakness. Is it my cup of tea? No, but at the end of the day, and this is what's really nice about futures trading and active trading in general, you can make money on both sides, right? Like, it's not a scenario where the contrarian goes against the trend follower and only one can win there. It's the same with options trading. How often have you sold a strangle or sold a straddle, iron condor, or whatever? It goes past you for 10, 20, 30 cents, and then hopefully it comes back because you did the higher probability thing. Guess what? Someone was on the long side of that trade, and before it came back, they took some money. Same here, especially with the second example of buying later in the day of the small 10-year product. Got down 30 cents, and it got down at some points 40 or even 50 cents before coming back. You can be a contrarian or a trend follower. That's totally up to you at the end of the day. Now, the last thing I want to hit before we maybe get to some questions and I get the hell out of here is trade management. And this is what's really, really nice, because the mean reverting trade at no point leaves you hanging out to dry. Like what I hate doing is going through a presentation and being like, here's a cool, fun thing. Good luck. We've covered trade entry here with mean reversion tactics and the standard deviation, but also you have to keep in mind trade management, and standard deviations also really help with this as well, which is to say, okay, I sold when it was up a full standard deviation. I bought when it was down more than a full standard deviation. Now, where do I manage the thing? Well, let me make it a function of that standard deviation. You don't want to say, okay, it was down 30 cents, which is $30 in small futures, and so I'm going to buy it here, and I'm going to look for $300. Where did you come up with that number? And also, that number isn't really realistic for this market that moves 30 or 40 cents, $30 or $40 on a daily basis. It would have to be a really big move on a one lot to get $300 while scalping. What I can say is, okay, I'm using the one standard deviation to enter, up or down 30 cents, let's call it. Well, when I buy the thing, let me look at maybe a half standard deviation is where I'm going to manage profits or losses. So in this scenario, the market opens at 1660. It gets down to 1630, and I buy those 1630s. That's down over one standard deviation. Where am I going to manage it? Well, I'm going to manage for a profit at 1645 or a loss down at 1615. So that's half a standard deviation on both sides, 15 cents or $15. You can attribute this to markets that move $100 per day, $200 per day, whatever the market is, whatever the standard deviation. A really good A to Z tool, and it's a tool that we publicize every single week in our small exchange newsletters here. You can see the standard deviations for all the small products, and we update these weekly, but you can use these as a good number for the foreseeable future here. You know, those stock products right around $1, that yield product, depending on which one you're looking at, like I said, around 30, 40 cents is a good measurement for the one standard deviation. Metals, very active recently, around $1 worth of movement, and then currencies, slower moving piece similar to those interest rates, around 50 cents. Once those standard deviations get in your mind and you think about them every time you just scroll through a watch list or bring up a market and quickly look at the net change, you can tell yourself, oh, there's opportunity there. Or, you know, oh, this SM75 product is only up 30 cents. There's nothing for me to really do in there. That's an inside day. And so this is a really nice data that we give to our subscribers every single week. So once again, subscribers.smallexchange.com for that information. But we do throw a lot of this out on Twitter. So if you want to go follow our Twitter, it's just at smallexchange.com. We give out little nuggets here and there to the general public. So in closing, mean reversion is a mathematical tool that can help traders of any time horizon to analyze, enter, and then manage markets here. It's a really nice, powerful tool. It's, like I said, it's pretty simple when you think about it. It's the average of this data and then the standard deviation, maybe a little bit more involved. But what's really nice is once you start thinking about this in the same way that a lot of people think about implied volatility rank, or they look at the VIX and they look at these little things to tell themselves quickly, you know, as I'm going through my platform in 5-10 seconds, is there opportunity there or is there not? This mean reversion is a great tool for finding that opportunity and then trading off of it from enter to management. Love the mean reversion trade, and I hope you guys enjoyed it too. Now, with that being said, you know, you want to apply these hopefully to the small exchange markets that help to make futures trading more accessible to more people. All these markets move around $100 per day or less. The only futures markets out there that move in that small, standard, and simple size for you, the everyday trader.